This is Dollar Logic, where we break down the hidden logic behind money, business, and the systems that shape your everyday life. No jargon, no fluff, just clear answers. You sign a stack of paperwork at 18 years old, barely understanding what you're agreeing to, and a few years later that paperwork turns into a monthly bill that can follow you for decades. Student loans fund the majority of college degrees in America, yet most students borrow without ever really understanding how the system works. Today we're breaking down student loans and the major changes that reshape the entire system in 2026. First, there's a critical distinction between federal and private student loans. Federal loans come from the U.S. government, carry fixed interest rates set by law, and come with borrower protections, like income-driven repayment and forgiveness programs, that private loans generally don't offer. Private loans come from banks or other lenders, are approved based on credit history, and typically offer far fewer safety nets if your income drops or you struggle to pay. Within federal loans, there's another key distinction: subsidized versus unsubsidized. Subsidized loans available to students with financial need don't accrue interest while you're in school, the government covers it. Unsubsidized loans start accruing interest the moment they're disbursed, even while you're still a student, which means the balance can quietly grow before you've even graduated. 2026 brought some of the biggest changes to federal student loans in years. A law called the One Big Beautiful Bill Act eliminated several existing income-driven repayment plans, including SAVE, PAYE, and ICR, phasing them out entirely by 2028. The SAVE plan specifically was struck down by a federal court in March 2026, and its interest had already resumed accruing the year before. In their place, a new plan called the Repayment Assistance Plan, or RAP, launched in mid-2026, setting payments between 1% and 10% of your income, with forgiveness available after 30 years if a balance remains. Another major shift: the Grad Plus loan program, which let graduate and professional students borrow up to their full cost of attendance, was eliminated for new borrowers starting in July 2026. Students in graduate or professional programs now need to plan around new borrowing limits, which may mean relying more on private loans to cover any remaining gap, a trade-off that comes without federal protections. Public Service Loan Forgiveness, often called PSLF, is still very much alive. If you work full-time for a qualifying government or nonprofit employer and make 120 qualifying monthly payments, roughly 10 years, your remaining federal loan balance can be forgiven. It remains one of the most valuable and most underused forgiveness programs available, largely because many borrowers don't realize their job or repayment plan actually qualifies. Income-based repayment, or IBR, has become one of the most stable remaining income-driven options, since it's protected under older law and wasn't caught up in the same legal challenges as SAVE. Under IBR, monthly payments are capped as a percentage of your discretionary income, with forgiveness typically after 20 or 25 years, depending on when your loans were disbursed. It's also worth understanding how loan servicers work. A servicer is the company that manages your monthly payments, not the lender itself in most federal loan cases. Your servicer can change over time, sometimes without much warning, which is part of why staying logged into student aid Gov and keeping your contact information updated matters more than people realize. So what should you actually do with all of this? Before taking on any student debt, run the numbers on your expected starting salary in your field against your total anticipated loan balance. A rough rule many advisors suggest is keeping your total federal debt below what you expect to earn in your first year out of school. If you already have loans, check which repayment plan you're on, since older plans may no longer be available for enrollment going forward. And if you work in public service, look into whether your employer qualifies for PSLF before assuming forgiveness isn't an option for you. Student loans aren't inherently good or bad. They're a tool that opens doors to education many people couldn't otherwise afford, but only if you understand exactly what you're signing up for. With the rules shifting as much as they have in 2026, staying informed isn't optional anymore. It's the only way to actually make the system work in your favor. That's how it actually works. Understanding money doesn't have to be complicated, it just has to be explained clearly. If this helped, subscribe to Dollar Logic for more videos that make sense of the systems around your money. See you in the next one.